What's up guys, let's go over order blocks or OBs. So what is an order block? An order block indicates a change in the state of delivery in the market. Order blocks represent large orders, institutional players participating in the market, which can be identified in price action. So how do you identify them? In the context of a bullish order block, it is defined as the lowest candle with a down close that has the most range between open to close and is near a support level, an old high or low. The validation of a bullish order block occurs when the high of the lowest candle, this right here, is traded through by a candle formed directly after. For a bearish order block, you would reverse the concept. Why are they important and how to trade with them? Order blocks are important because they help traders identify potential entry points, gauge institutional order flow, and manage risk in their trades. The midpoint of an order block, the MT, can be referenced as the order block's premium and discount range, offering enhanced precision. And we'll get into that in our MTCE video. So I'll show you guys some examples to make sure you understand in depth. So guys, let's go over an example here through the lens of the algorithm and institutional players in the market. So we have this area of sell side liquidity marked out. So as we know, the market is targeting this liquidity. It is targeting these stop loss orders. And we can actually confirm this through the institutional buying pressure shown right after. This green bullish candle is the institutions buying up these orders and thus blocking all these sell orders, all this selling volume, creating a order block. So I'm going to draw that up for you guys. This would be our order block, our bullish order block. And as you can see, we later use this as support to continue on up. So it's very simple guys. We're watching how the institutions play with the market, how these stop loss orders are taken, how the buying pressure is shown, and how we use these blocked orders as support. So here's a perfect example right here guys. As you can see, we take buy side liquidity and then institutions have that heavy selling pressure blocking these orders. We then come back into those orders as a level of support. We come back into these orders to basically pair their stop losses for our sell orders to go lower. This is the same thing with liquidity, and this is why it works. They're getting a higher price to cut the trade at, and we're getting a higher price to place our trade to go lower. So again, simply put, we take liquidity. Institutions are simply showing selling pressure, blocking these buy orders, and then we're using them as support to go lower. So a hugely important thing to note is order blocks are always more important with contexts like this. In an intraday setting, say this was New York market open and this was New York market close, you would be watching order blocks to gauge institutional order flow. They'll be one of your key indicators of price, bias, and how institutions are reacting to orders and the pace in which they want to reach their objective with. So if that didn't make a ton of sense, if you see some random ass order block, don't take an entry off of it. You need to pair it with context or else it's not going to work. In a more advanced lesson, you guys will learn about propulsion blocks, which are basically upgraded order blocks, and they involve the use of context. So I hope you guys like this video, and there'll be more videos like this soon.
Yeah, hello.